All right, guys. So in this section, I'll be talking about market intuition and how screen time and experience is so crucial to a trader's journey. There are some things in day trading that you cannot learn from a technical standpoint. You cannot learn from me telling you, but rather so from your own experience as your brain processes new information and creates a complex system where you're able to understand it a lot more effectively. First thing I'm talking about is market intuition, which refers to a trader's ability to perceive and interpret subtle movements and trends in the market. This involves deep understanding of market dynamics, market participants, and the factors influencing price movements. Market intuition is honed through experience, extensive screen time, and exposure to various market conditions. And these various market conditions can last years, meaning you won't get the full gist of how the market moves until you have probably a few years experience. That doesn't mean you won't be profitable until a few years experience, but you won't fully understand the market until you experience all of the phases and types of market conditions you would trade under. For example, during COVID, we had a bear market, obviously. It was so easy to trade during the COVID market. You had to buy, all you had to do was short the market every single day, and you're basically guaranteed profit. You didn't know how to learn how to trade, but now it's different. Now we are in sort of a ranging market call, depending on, again, depending on when you're watching this recording for this course, really depends, but we are in a lot more harder market to trade for sure. So market conditions do change over time. And this can be considered a form of intuition or gut feeling that guides decision making and it helps identify potential trading opportunities. So this is something that only comes from experience. Screen time refers to the amount of time spent actively observing and analyzing market data, charts, and price action, which is key. Experience is gained through consistent involvement in trading, actively participating in the markets each and every single day, and learning from both losses and winners. Spending sufficient screen time and gaining experience helps traders develop a comprehensive understanding of market behavior and dynamics, and this allows traders to recognize recurring patterns, identifying support and resistance levels a lot easier and a lot effectively, and understanding the nuances of different trading instruments, meaning different assets. And the more screen time and experience the trader accumulates, the better equipped they become at making informed decisions and managing risk effectively. This is crucial, and I can definitely relate to this because in the beginning it was hard to combine all my trading setups and confidence together, but now it's instant execution. I know my exact setup. When I see it, I instantly execute. I know my exact risk as well. I don't have to calculate this as much really. I know roughly exactly how much I'm risking and what my setups are. My setups are instantly executed. I can analyze the market effectively. You give me 30 seconds, you give me a chart, right? Give me 30 seconds to look at it, and I can tell you which way or where price is expected to go and where I would be entering. Boom, done. That's not something you can really learn from just learning all this stuff and memorizing this stuff. This comes from market experience. Now, next thing I want to talk about is market intuition and how screen time both play a crucial role in building resilience, emotional control, and discipline and essential qualities for long-term trading success. All right, so in terms of emotional control, when you have a lot of this market experience, emotional control becomes something that's almost like gone in a sense. Personally, that's just for me. I guess it really depends on person to person and how each person is able to control their emotions. But for me, there isn't much of an emotional, psychological side of the trading anymore to me. Sounds quite absurd, right? But there just really isn't a psychological aspect to trading for me anymore because I've gone through every single cycle I possibly can through the motions, wins and losses. I've gone through the whole learning equity curve, and you will learn. And that equity curve, trust me, will truly shape who you are as a person outside the charts as well. And while you're in the charts, it will truly you kind of go emotionless. I'm not gonna lie, because trading kind of becomes more so like a game. Obviously, a game with real money, but it comes kind of like a game almost. There's not really much emotional aspect to trading for me anymore. So there's that. So honestly, at this point in my trading career, I would say personally, it just comes down to more experience and screen time. You can always learn more from the way markets move, as well as always learning more new information about the markets and how it develops. But aside from that, there's not really much psychologically I can really learn because I'm kind of operating like a bot at this point. But when it comes to trading, market intuition may vary based on the asset, like I mentioned. So each asset has its own personality in a way and moves differently. For example, oil and gold do not move the same. They move way differently. All right. Oil is a lot more volatile than gold. Every move oil has is usually 1 to 2% to 3% before it reverses. I know all these statistical data facts based on my experience in screen time watching the chart and asset play out. And while gold, on the other hand, usually moves at maximum 1% before reversing or doing something consolidation phase or anything else. Just as many other things as well as time frames. For example, I know gold typically moves very volatile around 8:30 to 12. After 12, gold does not move much and typically consolidates. Oil, on the other hand, tends to move a good amount until 2 p.m. And oil reopens at a different time as well. And also, volatility hours and volume are all different. There's so many things when it comes to trading assets. Every asset moves differently. It's basically it's a whole. You can see it's a whole different industry almost. You know, you're executing the same setups. All right. For example, sometimes I would actually trade these assets just slightly differently. Like my stop losses and take profit loads would be a little bit differently depending on the asset I trade. And this just comes with practice and time. That's literally it. Practice, time, dedication, hard work will get you there. And a lot of people don't realize this. And if you don't realize these assets have different personalities, you think it's all the same, you have a long way to go. I would say for sure. You need a lot more experience and don't underestimate the power of screen time. That's for sure. Now, the same thing applies to the stock market. Different stocks move way differently. I would say stocks can move way differently depending on which stock you're looking at. So, yeah, this is why it's so crucial to stick to actually a few assets you're really familiar with and just trade those rather than trying to trade everything. A lot of traders in the beginning, they try to trade every single thing they look at and think they can be the boss of everything. In reality, that's not an efficient way of becoming profitable. If you really want to become profitable, you have to focus on a few things, all right? For me personally, for example, I like to focus on roughly 5 Forex pairs in commodities. And then for day trading in the market, in the stock market, I typically only trade SPY. Sometimes I'll trade, 1 or 2 tech stocks, but most of the times it's SPY or NASDAQ, the big ETFs. That's it. And master those. Now, the last thing is volatility to volume and time is also how much price tends to move in a direction, the range of price action, and it is a strong reversal asset, or if it's a trend continuation asset, and many more factors that lead to the center of asset's personality. So these 3 things are also a key thing you want to look at when it comes to analyzing different assets.